Neil, thanks very much for coming coming here to the Cayman Islands for the CASE conference and then getting a chance to come sit down with us.
It's a pleasure being with you.
What I'd love to do is now we've got you here, is get an idea of how you're thinking about the world, because there's a lot going on. And I've got some very strong views, and a lot of people have got conflicting views out there. I'd love to hear what your framework is right now.
Well, the big picture framework is maybe considering the fact that one, potential growth both in advanced economies and emerging markets has fallen in the last few years. It's partly demographics, it's partly deleveraging, it's partly a variety of other global factors that are driving potential growth to be lower, aging of population, underinvestment in physical human capital, lower total factor productivity growth. So potential growth is lower. Some people go as far as say we are in a cycle of stagnation. I'm not sure if that's the case, but certainly we're there. Two, actual economic growth for the last few years has been also below potential. And it's been below potential because you had essentially three waves of deleveraging. The first one started in the US after the bust of housing and credit, and it spread to Europe where you had too much private and public debt. And now we're at the beginning of the third stage of this great deleveraging that is in emerging markets that also spent the last 10 years borrowing too much. So there are these waves that imply that once you have to deleverage, you have to spend less to save more or save less, and actual growth is even below potential. So potential growth, say, an emerging market used to be 5, 6, now it's 4, 5, but actual growth in a deleveraging has to be below potential. So I expect emerging market, not just in China, but overall, growing much lower than before. So the average emerging market is going to grow only 3.5%. So because of this, we live in a world in which there is too much savings, there is too little investment. Therefore, equilibrium real long rates safe are low, close to zero, if not negative, and they're going to stay low. Those are riskless rates for a long period of time. It's also a world in which, since there is too much saving, not enough investment, too much production, not enough demand, too much supply, not enough consumption. There is a glut of capacity in goods, in services, in labor, now even in commodity prices. Disinflationary, if not deflationary, pressure are going to be ongoing, and therefore, with real rates low and inflation low, long-term interest rates are going to stay low. Three is a world in which, because of these pressures that are deflationary and with low growth, and since structural reforms occur only slowly, and where fiscal policy is constrained by politics and markets, the only game in town, to use the term used by Mohamed El-Arian in his latest book, are central bank. And central bank have gone to the whole gamut of now unconventional monetary policies, things that did not even exist a decade ago are the norm. Zero policy rates, quantitative easing, credit easing, forward guidance, now negative policy rates, unsterilized effects intervention, now even capital controls, and more of the same. Now, this year was supposed to be the year where you had a great divergence between monetary policy of the Fed and the Bank of England and those of Japan and Europe. But I think instead of divergence, we end up with convergence that push towards zero policy rates and then negative. Net rates started first in the smaller European countries, Switzerland, Sweden, Denmark. Then it spread to ECB and the Eurozone. Now it spread as of last few days to Japan. And for how long the BOJ and the ECB can go even more negative while the Fed goes higher in the policy rate. I think that with the weakness of US economic growth, disinflationary pressure, now with the global tail risks, the risk is that actually even the Fed...
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
Goes higher in the policy rate. I think that with the weakness of US economic growth, disinflationary pressure, now with the global tail risks, the risk is that actually even the Fed eventually goes negative. So, minus 1% policy rate will become the new zero. And that may be the world we live in. It's a strange, weird world because who would have thought that policy rates could be negative would have thought the long-term interest rates could be negative, but in a world in which you're earning zero on the short end of the yield curve, then the entire yield curve is priced downwards. And we see now already $3 trillion equivalent of US bonds around the world, from the Eurozone, rest of Europe, and now Japan. They're trading at negative yield, at maturities going all the way to 10-year and plus. And will be in this strange world.
So the negative interest rates, what do you think that does to, for example, the European banks? Something I've been looking at thinking, something doesn't look right. And I have a feeling it's the shift towards negative interest rates. How do you see that negative interest rate playing out within the banking sector?
Well, not just in European banks. I think that for banks around the world, from European to Japanese to US now, I would say that banks are under squeeze for two reasons. One, net interest margins are being squeezed first by quantitative easing, because you push down long-term interest rates while you have policy rates at zero. So that was already hurting the net interest margin of the banks. Now that you're going negative with the policy rates, you have a further squeeze on the net interest margin of the banks. And in the medium long term, of course, the banking system is challenged by fintech and all those peer-to-peer lending, and the entire revolution is going to occur in the provision of banking, payments, and financial services. So my view is that probably European banks, Japanese banks, but now even US banks are going to be under squeeze. I would short probably global banks compared to even the S&P or global equities. I think that banks are going to actually underperform the market, given the squeezes that comes from both long-term factors and short-term factors. Now, the ECB, like the BOJ, are saying, well, we want to try to avoid a credit slowdown because of the squeeze on the banks. Therefore, if we're going to go more negative, we're going to do a two-tier system. The Swiss have done the two-tier system with exceptions. Now, BOJ has done it. The ECB has not done it yet, but if they're going to go as likely March from minus 30 to minus 40 or minus 50 with the NDR, they'll have to go to a two-tier system where the more negative interest rate is imposed only on the new excess reserves as opposed to the average ones. But that only has a temporary impact on the margins of the banks. It still has a squeeze on the banking system. So you'll have all these things about trying to avoid excessive squeeze on the profitability of the banking systems, avoid slowdown in credit growth. So the central banks will become even more esoteric in the way they apply these negative policy rates, but they can only dampen that impact. They cannot really counteract it significantly.
And what do you think about the idea of the ban on cash that's being circulated around? I know the IMF have written some papers about it. Everyone's talking about it, trying to get cash out of the system, because then I guess financial repression is a lot easier, because then you can obviously lower interest rates a lot in the banking system.
Well, the limit to going negative with the policy rate is, of course, that of the two components of base money, the excess reserves of the banks are taxed at the negative, while cash is still earning you zero. If central banks are going to go even more negative at some point, the banks might want to decide not to hold essentially these excess reserves and going into cash. Now, we're not yet at that point, and people are debating what's that point. Some people are estimating that only when the policy rate is more than minus 1%, you go there, because actually it's risky to hold that cash. You have to store it, you have to insure it. There's all sorts of temperature and so on. So we've seen in Switzerland, in Sweden, and Denmark, where policy rates are minus 75, and then you have not had that switch. Now, suppose you want to go much more negative, and then banks want to switch into cash. There are two options in that case. One, you can start taxing cash, and once we have electronic money, that's easy. Even if you don't have electronic money, I think you can do it, because suppose that every time that you go to an ATM machine, you get cash, you're charged a fee, say 1%, or even when you go to the teller. That's one way of taxing cash. So that solution prevents the switch from excess reserves into cash. The second option that central banks might consider, again, might sound esoteric and unconventional, is to tell the banks, you want to switch into cash, I'm not going to let you. I'll give you only as much cash as you need for the transaction with your depositors and what the deposit need for using money for transaction. Above that one, you don't need that cash, I'm not agreeing to you. It's a form of capital control. And then you can go even more negative.
Because they did that in Switzerland. One of the pension funds, one of the cantonal pension funds, tried to take the cash out and put it into the bank. Bank wouldn't let them do it.
Yeah. I think that we're going to go in that direction. I mean, the central bank can tell the banks, sorry, but you don't need this cash, and I'm not agreeing with you. End of the story. So you can do variants of financial repression in such a way that once all of the base money, including cash, is taxed indirectly, or you cannot switch, then you can go even more negative with the policy rate.
So what are we supposed to do about it? Let's assume you and I are savers. What do we do in that situation?
Unfortunately, we live in a world in which, on one side, you have these unconventional monetary policies, so policy rates are going negative, and therefore long-term interest rates are going towards zero, if not negative. And on the other side, for the last few years, these unconventional monetary policies have led to asset reflation. So if you are a saver and holder assets, you've done actually quite well. U.S. and global equity from the bottom of March 09 have gone up 150, 170%. So even with the current correction, 5, 10, 15%, you're still better off. But if I look at the investment landscape around the world, we live in a world in which today most risky assets are very expensive, in part because zero policy rates are negative and the central bank suppressing volatility. So public equities are expensive, even with the correction. P/E ratios, either the adjusted one or otherwise, look high, certainly in the United States. Private equity is also quite expensive, and private equity firms have lots of money they have to put at work, and they find it harder to find cheap assets. Many of these internet unicorns are very expensive, and one wonder whether they're worth those billion-dollar valuation, implicit or explicitly. There'll be a shakeout there. Real estate is very expensive throughout the world. There is frothiness in housing markets. In many, I would say, we identified at Roubini Global Economics at least a dozen commercial and residential markets where it is expensive. Credit has been very expensive until recently. And of course, now a correction has occurred in the high yield, but more has to go. Of course, in the yen space, until 2 years ago, before the shakeout that came from the slowdown of China and the taper tantrum, EM equities were expensive, commodities were expensive, EM credit was expensive, EM currency were expensive. That kind of bursting of that bubble has already occurred, is ongoing. So those assets are not expensive any longer, but used to be expensive. So we live in a world in which, unfortunately, most of the returns from zero policy rates and conventional monetary policy occurred in the past. And now the valuations are so high, expected returns have to be relatively low in the future on average on risky assets. Of course, if you are a superior investor, you can play some of the idiosyncrasies and you can try to, of course, short some assets, go long other ones, and you can make money, but you have to be a superior, first of all, asset manager, investor. But then the average of the market, by definition, earns the market. And the market return, by definition, are going to be low across a wide range of risky assets.
But the hard thing is we can't own cash because they're about to tax it or ban its use in certain ways, and you'll have negative interest rates.
Yeah.
So it makes it really complicated to find an avenue to invest, to even protect yourself. You've got US Treasury bonds, but then other than that, as you said, most of these assets are expensive or still falling in the commodity supercycle on the downside, etc.
Well, cash used to give you zero return and protect you against capital losses on risky assets. Even if you're earning -1 on it, you're, first of all, still doing better than something to correct 20, 30%. Two, with deflation in real terms, actually, even -1 might be closer to zero or being positive. Look at the experience of Japan, where they had zero policy rate for a decade and real returns were high because they had deflation. So in real terms, actually, with deflation, you can get real returns are positive on cash. So I would say in a world in which risky asset can correct 10, 20, 30%, cash is still king, even if you tax it at -1 or -2. Better to get -2 rather than getting -20, right? It's all relative.
Because it used to be a positively, kind of a positive carry put option, and now you just basically you're paying for that put option. You pay the 1%.
Yeah, you pay a fee for that insurance against massive capital losses. So you still pay for it, and better off that way rather than losing your capital.
And okay, so that's at a shorter term base. But if you want to save money over time, how do you do that? I mean, I understand it makes sense. If I want to switch, I think, like you, I think the world is relatively risky right now. So to hold cash, fine. Pay the 1%, no problem.
Yeah.
But if I want to save money over, 10 years, I want to accumulate cash because I've got a business that generates money. What do you do with it?
I would say that then you have to go more specific. You have to find either the indices of the future or the countries of the future where probably in relative terms, returns are going to be high. I mean, if I had to think about technology, the good news about it is that there is 6 or 7 indices of the future where there's a massive amounts of innovation disruption. I call it ET, energy technologies. That is not just, of course, alternative fossil fuels, but also clean tech, solar, green economy, you name it. Solar could do very well in the next decade. And now with batteries being able to store that solar power, it may be a revolution. Secondly, with BT, biotechnologies, all the things in biomedical research are going to make us live longer and healthier until we're 100 plus. There'll be a revolution there. Of course, IT is still huge. Information technologies, Web 2.0, 3.0, social media, Internet of Things, cloud computing, and all the
These things are all
revolutions
expensive, though. Almost all of them, because it's a generally accepted thing that these are the opportunities.
They're expensive, but some of them, I would say, if you pick the right firms, there'll be some winners. I mean, you have 4 major internet companies around the world globally. I mean, leaving aside the Chinese, among the US one, you have Google, Amazon, Facebook, Apple. Maybe all of them are going to be winner. Maybe some of them are going to be more winner than others. You have to make choices. But even if you pick 2 of them are going to succeed compared to the other ones. I mean, look at Google just the other day. Earnings have surprised on the upside, and they're going to do well. And they're going to go into much more esoteric stuff like artificial intelligence and biomedical research and life sciences and you name it. So, some things look expensive, but actually they may not be. The average, I would say, internet unicorn is very expensive. But as I said, in information technologies, the revolution, or the manufacturing technologies, we're at the beginning of robotics, automation, artificial intelligence, 3D printing, personalized manufacturing. That's a revolution. Or look at the FT, fintech, and all the revolution disruptions occur from banking, payment system, blockchain, even an algorithm used for asset management, you name it. And finally, I would say also DT, defense technology, in the world in which there are geopolitical risk, there are going to be major application of high-tech to defense system, as we're seeing with drones and lots of other stuff. So you have at least, between ET, BT, IT, MT, FT, and so on. You have lots of new technology, new disruptions. Some of them, as you point out, are expensive. Some of them are not yet expensive enough because there'll be some major winners. So I think technology, of course, is one space where people can go and pick and choose. And then you have to think about also which countries in the world are going to be winning this technology race. For example, all in all, I would say the United States in these 6 industries of the future as firms that are very successful, and it can win at least 5 or 6 of these industries. If you look at biotech, probably Switzerland is maybe parts in Japan or Germany. If you're looking at robotic and automation, is Japan that is very advanced, and so on. So there are very few countries that have, I would say, comparative advantage in all 6 of them. US is one of them. So you have to pick also and choose the countries that are going to do well from that point of view.
Talking of expensive things, what do you think of the RMB and the Chinese currency and the Chinese economy, I guess?
Yeah, my view has been all along that, I think people were too optimistic about China. Until a year ago, they believed in the Kool-Aid of the authorities. They were saying there'll be a soft landing, growth 7% plus, and everything will be fine. And these guys were considered geniuses, and super technocrats could do no wrong. And markets tend to be manic depressive, gone from excessive optimism about China to now excessive pessimism, saying, no, these are a bunch of incompetent people. They cannot stabilize growth. They're lying. They're cheating. Growth is not 7, it's not even 6, it's 4 going to 0. It's going to be a nasty hard landing. So we've gone from a soft landing to the extreme of hard landing, and from excessive optimism to excessive pessimism. And I think that both views are wrong. I mean, we've been saying all along at Roubini Global Economics for the last 3-4 years that this is going to be a bumpy landing, that Chinese growth is going to slow down sharply. From when it was 10 towards 8, 7. We believe the 7 they announced today is not 7, but is 6. But it's 6. Those people who say it's already at 4 going to 0, I think they get it wrong. Because the big change occurring in China today is rebalancing. Services that used to be a third of the economy now are 50% of the economy. Services are growing 7-8%. Manufacturing is growing 4-5. The average of the two 50-50 share gives you a growth handle of low 6. Not 7, but low 6. And that low 6 is going to become 5 because potential growth is 5. And of course, in a deleveraging, growth could be slightly below 5. So it's going to be very bumpy. But as long as it's not a hard landing, it means that the stock market is not going to go into free fall, that the Chinese are not going to let their currency collapse, and it's going to be bumpy, it's going to be noisy, it's going to be a source of volatility for global market. But I don't think that China is in a free fall. We think it's going to be bumpy, it's going to be, of course, causing significant amount of global financial disruption, but not a global recession. To have a global recession or to have a global financial crisis, you have to assume that your baseline is a Chinese hard landing, Chinese recession, that is then a collapse of emerging markets. And since China and emerging markets are 50% of global GDP, then to trade and more importantly financial channel, if China has a hard landing, the stock market falls by 30%, then you have a global bear market, and then central bank cannot even compensate for that, and then we go into a global recession. So to us, this is a 20% probability scenario, it's not 50 plus, the way it is for some buy side or even some of the independent research firms. So we worry about China, but we don't just worry about China, because I think that in thinking about this global turmoil episode, in the past, every time you have a 10% correction, there have been risk-off episodes, is triggered only by one factor. A few years ago, people worried about the Eurozone collapsing, or recently last year about maybe in the spring Brexit, and then the summer was about China. I think this current episode that is more than a correction is because the tail factors are many. There's, of course, the concern about China, our landing of the growth of the economy, of the currency, of the stock market. I'm not in that camp, but the people worry about that. There's a worry that US growth is faltering and the Fed made a mistake by hiking rate in December, and they'll have to reverse it or go more slowly. There's worries about all this geopolitical risk around the world, starting with the fact that the Middle East is imploding. You have this probably beginning of a 30-year war between Sunni Saudi Arabia and Shia Iran, and it's getting worse, and you have proxy wars from Iraq to Syria, to Lebanon, to Yemen, to Libya, and the future, God knows. You have this paradox that oil prices are collapsing, and in spite of that, stock markets are going down. And it's a bit of a paradox, because a fall in oil prices, as long as it's driven by a positive supply shock, should be good for the global economy, right? Because the major region of the world are all importing. US is all importing, Europe, Japan, China, India, Korea, the next in Asia, Turkey. So why the falling in oil prices leads to a global equity market correction? I think for three reasons. One is that people believe this is not just a global supply shock, it's positive, might be a signal of a weakness of global aggregate demand, weakness of growth in China, in emerging market in US. That's first reason. Second, in the US, energy sector is an important part of the economy. So while the US economy on net benefits from lower oil prices, because the benefit to consumer is greater than the loss to producer, in the short run, production, employment, and capex in the oil sector falls, and that's weakens economic growth and weakens the stock market. And the consumer take the windfall and they save it, and they spend it maybe by the second half of the year, like it happened in 2014 and like it happened last year. I think this year will have the same pattern, but you have this correction. And three, the fall in oil energy prices implies there is credit risk for oil and energy companies in the US, but also around the world, and for sovereigns and corporates in those countries that are net oil exporters. So we have this paradox that every time oil prices go down, equities in US and globally correct downwards. So that's another source of risk. You add to that market illiquidity, the lack of market makers, and the risk of having something systemic in credit markets interacting with this repricing of high yield as well. And then you have finally letting all the sorts of concerns, especially political, about Europe and the Eurozone. I mean, you have terrorism as a risk. You have the migration crisis, an existential threat to Europe. You have the risk of Brexit that's not gone away, but they've been postponed. Now the risk of Brexit or British exit from the European Union is rising. And you have now, populist parties of the right and the left that are becoming extremely noisy, both in the core and the periphery of Eurozone, and not just in Eurozone, but throughout Europe. Look what's happening in Poland, what's happening in Hungary, and so on. And you have these populist parties that are becoming quite anti-free trade, anti-migrants, anti-globalization, anti-technology. They're becoming very noisy throughout Europe.
So if you get all of these tail risk probabilities, let's assume there's 6 or 7 of them out there, there's a lot.
Yeah.
Then surely those combine into creating quite a risk of a bad event. It's very difficult to avoid all of these happening. Of course we can.
Yeah.
What's your risk of a global recession or a global illiquidity event of some magnitude?
Well, of all these things, I would say you have to be nuanced. The one that can trigger a global recession, if it materializes even by itself, is a hard landing by China.
So you don't think we're anywhere near a recession yet?
As I said, our view will be that China by itself maybe gives you a risk of a global recession of 15 to 20%. Other tail risk added to it may give you more a total cumulative probability of 25%. I mean, the good news is not 50, is not the baseline. Bad news is that even 1 out of 4 probability of a global recession is high. And as I said, some of these things are slow motion, like the problems of the Eurozone political are slow motion train wreck. I think that, the Fed made a policy mistake and US growth may be stalling, then they'll have to go back to zero or even negative, so they can act on that one. Same thing for many of the other risks out there. And in the past, every risk-off episode has actually been just a risk-off temporary, and then asset prices go back to the previous level, even higher. This time around, they can go the same or can stay with a correction, or the correction can become a bear market. I think the answer to that question depends on two things. One, what will be the economic data? And the more optimistic case would say, listen, China is not free falling, and markets are pricing free falling. US growth is a mixed bag. Traded sector weak, non-traded fine, manufacturing bad, services good, GDP weak, employment good. Suppose the US data in the next couple of quarters turn out to surprise on the upside and the downside. So if China is not free falling, if US avoids a stall, and the latest US economic data from Eurozone and Japan actually are being on the upside and the downside, you have 4 of the major economies in the world that are okay. So could be that the data actually imply this is just panic. First observation. Secondly, suppose the data are still weak, then in the past, what saved the day in terms of asset price has been central banks and policymakers coming to the rescue of the market. And already in the last few weeks, we've had already the ECB saying we're going to ease in March, the BOJ actually easing, PBOC is likely to do another round of monetary easing. The central bank, not just central bank, but the Fiscal Authority of China will have to do another fiscal stimulus. And suppose that the Fed had said in December, we're going to hike 4 times in 2016. Doesn't hike 4 times. I think March is completely off the table. Even April, maybe they start hiking again in June. Maybe 2 hikes this year. And maybe things are bad. They do 0 hikes this year, or they could go even negative, right? So they're going to respond. So suppose that the major central banks in the world, whether it's the PBOC, the Fed, BOJ, ECB, and even the Bank of England, decide either not to hike or to continue and ease more. In the past, that has lifted risky assets, and maybe that's going to be enough. You know, when the ECB, after the Governing Council meeting in January, said we may ease more in March, the stock market in Europe went up almost by 3% that day, and the next day went up by 5% in Japan. So those who say that the central banks are running out of ammunition, I think they get it wrong. The marginal return of those unconventional policies is maybe less than the past, and we have to recognize it in a world in which asset prices are already high and elevated. So the upside is limited, but maybe you can control some of the downside risk because you can do more QE, more credit easing, more forward guidance, more FX intervention, more negative policy rates, more of all this esoteric stuff. The ability and willingness of central bank of doing it has not gone away, even if the marginal returns from doing it is not as high as the past.
And you don't see any problem with the omnipotence of central banks and the ability to try, or their desire to try, very untested economic theory on the global markets? I mean, do you think, are you just one of the proponents who say, well, let's give it a go, let's find out how it works? Or do you think, you know what, maybe we're not creating the right behavior to get rid of the debt problems or whatever else?
Well, we live in a world in which growth is low, potential and actual, in which debt is too high. But the solution to these problems, those that have to do with a structural reform, increase aggregate supply. And we need to increase aggregate supply and potential growth. But the problem we're facing today is not the fact that there is too much demand relative to supply. Is that maybe potential growth has fallen, but demand is weakened even further. Therefore, there's an upward gap in labor market, goods market, and commodities. So there is a lack of aggregate demand. Now, to resolve lack of aggregate demand, you have to do several things. You have to boost aggregate demand. Now, some things mean reduce the levels of debt so you can spend more. Some of the radical options like defaulting or inflation or capital levies on the wealthy or other ugly stuff has other collateral damage. That's why debt monetization is a better solution, because you're reducing the debt burden and debt servicing for those who are debtor. And of course, you're taxing creditors and savers. And that's why we've done debt monetization. Of all the options compared to other ones, is the least costly. And to boost aggregate demand, you need to have either monetary and or fiscal easing. Now, I'm a proponent of fiscal policy. I think that everywhere around the world, we've not done enough fiscal stimulus, and we have actually withdrawn the fiscal stimulus, done austerity too much, too fast, too soon, and then led to double-dip recession in the UK, in the Eurozone, in Europe, in Japan, among others. But if fiscal policy is constrained either by politics or by markets, then the only game in town is monetary policy. And in order to avoid double-dip recession and asset prices collapsing, you have no option by continuing with very esoteric and unconventional monetary policy. Is the path of least resistance. Is the second best or third best policy in the world, in which first best policy that have to do with structural reforms and fiscal stimulus are not viable. That's the world we live in. So it's second best, but it's second best. And the alternative of not doing it is worse. Because, when the Eurozone did too much fiscal austerity and they didn't do the QE, they went in double dip. And now the Eurozone is picking up because there is less fiscal austerity and because they're doing very unconventional, esoteric stuff. So it's all relative. You have to ask yourself, if you don't do this unconventional stuff, will the world be better? No, the world is going to be worse.
Yeah, and also going into the US political cycle, I think it's a much more palatable thing for the central bank to finance the government fiscal expenditure to go out and build bridges and roads and whatever it needs. And the infrastructure in the US is awful.
Yeah.
I mean, so it's politically a much easier thing to do versus the 1% and the 99% that went with QE that kind of upset a lot of people. So if you're to look, just to wrap things up, if you're to look at something that other people are not seeing, that you're saying that people don't get this, what is it?
Well, I would point out that people probably be surprised on how unconventional monetary policy is going to become, even in the US. This idea that the divergence, I don't think is going to correct. We'll move in a world in which everybody, including the Fed, is going to do more unconventional stuff. Secondly, we live in a world in which unconventional things like a variety of types of capital controls are going to become also the norm. Greece started with capital controls last year. Now China, because of the pressure on the currency, is going to experiment with capital controls on outflows. And if China does it, other emerging markets are going to find it appealing. Even the IMF has no orthodoxy anymore on capital controls. And capital controls are going to occur also on domestic banks. When banks want to switch from excess reserves into cash, the central banks are going to tell them, sorry, you cannot do it. That's a form of capital control or payment control of one sort. So I think we're going to live in a world in which there is more of this balkanization of domestic international financial systems. That's, I think, is one of the consequences of this world. We will probably be also in a world in which once we are running out of monetary tools, we'll have to go back to fiscal policy because we are at some point running out of monetary tools, even if you become more unconventional. And I think there's a very strong case that the IMF and others have made for public investment. The only country in the world that has too much public investment infrastructure is China. There is a dearth of that public infrastructures in emerging markets, but also in the US or even in Germany, where the highways are crumbling and you don't have digital infrastructure. So whether you do it as a public investment, a private investment, or private-public investment through PPPs, with policy rates at zero negative, with long-term interest rates in nominal terms low, sometimes negatives, and real terms negative, those public investments must have returns over the next 10, 20 years that are much higher than a real rate that is negative. So there is an opportunity of borrowing cheaply when interest rates are low to do something that benefits, because the good thing about public investment is not just something increases aggregate demand because you're boosting investment, but it also increases aggregate supply, and the return of private investment and the productivity of private investment depends on the existence of proper infrastructure, not just the traditional ones that many emerging markets need, but the non-traditional ones, like, for example, having a digital infrastructure, having a smart power grid, or having a whole solar system. There's lots of stuff out there that we need.
But Japan,
so that's the opportunity.
Japan tried a lot of this by a lot of fiscal stimulus in the past, and the economy never held up. How do you get it to generate some sort of longevity of that aggregate demand increase?
I think that part of it is that Japan arrived to QE or zero policy rates and then fiscal stimulus too late. It took them a decade after the bursting of their real estate and equity bubble to start doing something really esoteric on fiscal monetary policy, and then ended up into a debt and deflation trap.
They were building bridges and stuff.
They were building. In Japan, they were doing lots of silly investments, like they were building a marine in every little fisherman village in Japan, and there are hundreds of empty marinas. And there are some bridges to nowhere and so on. I would say you have to be smart. In this world in which there is massive disruption, the digital infrastructure is key. As I said, it can be built both by the private and the public sector. Some traditional infrastructure in some countries are needed, like emerging markets. In US, they're needed. Highways in Germany are needed. Japan probably doesn't need them. You have to be smart about which type of public investment and public infrastructures or public-private are needed. And in each country, you're going to have a different answer. But there is plenty of room to do so. In Japan, of course, for the Olympic Games, they're going to have to do a lot of infrastructure, and they're going to also actually hire from abroad lots of workers because they don't have the labor force. to actually build all this stuff. So you have to be intelligent, and you can do lots of mistakes by the wrong infrastructure, but there is lots of stuff out there that could be actually positive effects, both aggregate demand and aggregate supply.
Brilliant. Nouriel, thanks very much. Really enjoyed it.
Great being with you today.
Thanks.
Pleasure.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.